You are sitting on your couch late at night, staring at your phone. You've just watched a video about some 22-year-old kid who made a 30% return on a tech stock. And you feel that familiar, quiet knot of anxiety in your stomach. The feeling that you are falling behind. The feeling that everyone else was handed a rulebook to a game you don't even know how to play. You finally gather the motivation to download a brokerage app. You open it up, ready to change your life. Instantly, you are hit with a concrete wall of acronyms. Pay-RA ratios, market caps, moving averages, bid-ask spreads, dividend yields. Your brain freezes. You tell yourself, I'll research this over the weekend when I have more time and energy. You close the app, and the weekend never comes. That procrastination loop, that specific feeling of being paralyzed by jargon, stops right now. The financial industry does not use complex language because investing is inherently complicated. They use it as a psychological toll booth. Wall Street is a highly optimized machine that benefits directly from your confusion. When you feel overwhelmed, you surrender your agency. You hand your money over to professionals who charge you massive fees just to do what you could have done yourself in 10 minutes. Studies consistently show that financial illiteracy costs the average adult thousands of dollars every single year in missed opportunities and predatory fees. Over a lifetime, that ignorance is the equivalent of buying a luxury car and driving it straight into the ocean. Today, we are going to drain the water. We are going to take the most heavily guarded, artificially complicated concepts of the stock market and strip them down to their raw mechanical truth. No fluff, no condescension, just the absolute unvarnished logic of how wealth is actually built and protected. To understand the casino, you first have to understand the chips. When you buy a stock or a share, you are not buying a blinking ticker symbol on a screen. You are buying a legally binding percentage of a real business. You own a fraction of their desks, their patents, their inventory, and most importantly, their future profits. But this is where the very first trap is set for beginners. New investors log into their accounts, see company A trading at $5 a share and company B trading at $500 a share. They immediately assume company A is cheap and company B is expensive. This is a fundamental misunderstanding of reality. The price of a single share means absolutely nothing without context. What matters is the market capitalization, or market cap. Imagine two pizzas. The first pizza costs $1.00, but it is only sliced into 4 massive pieces. Each piece costs $25. The second pizza costs $10, but it is sliced into 1,000 tiny crumbs. Each crumb costs a penny. The crumb is cheaper, but you are getting practically nothing. Market cap is the total value of the entire pizza. You calculate it by taking the share price and multiplying it by the total number of shares the company has issued. A company trading at $5 a share with 1 billion shares outstanding is worth $5 billion. A company trading at $500 a share with only 1 million shares outstanding is worth $500 million. The $5 stock is actually 10 times more expensive than the $500 stock. Never judge a company by its slice, always look at the size of the entire pie. Once you understand what a company is worth, you have to figure out if it is actually making any money. This brings us to earnings per share, or EPS. If a company makes $10 million in pure profit and has 1 million shares, the EPS is $10. For every share you own, the business generated $10 of real wealth. But how much are investors willing to pay for that $10? That is the price-to-earnings ratio, the famous PE ratio. If that same stock is trading at $200 a share, and it generates $10 in EPS, the PE ratio is 20. You are paying $20 for every $1 of profit the company makes. Many beginners hear this and immediately think they should only buy stocks with the lowest possible PE ratio. Why pay $50 for $1 of profit when you can pay $5? Because the stock market is not a mirror reflecting the present, it is a telescope looking into the future. A company might have a low PE of 5 because Wall Street knows its core product is obsolete and its profits are about to fall off a cliff. It is cheap because it is dying. Conversely, a tech company might have a massive P/E of 100, because investors believe its profits will triple over the next 3 years. You always have to weigh the current price against the future growth. This forward-looking mechanism is exactly why earnings reports drive beginners crazy. 4 times a year, public companies release their financial report cards. You might see a headline that says a company just announced record-breaking massive profits. You rush to check the stock price, expecting it to be soaring, only to see it plummeting by 15%. How is that possible? It happens because those record profits were already expected. Wall Street had already priced them in months ago. But during the earnings call, the CEO mentioned that next quarter's sales might be slightly slower than anticipated. The market does not care what you did yesterday. It only cares what you are going to do tomorrow. The stock crashes because the future suddenly looks slightly less perfect than the price demanded. Let's talk about the cash flow mirage. When a company makes a profit, it can either reinvest that cash into building new factories and hiring new engineers, or it can hand that cash directly back to the shareholders. If they hand it back, that is called a dividend. The financial media often sells dividends to beginners as magical free money. It is not free money. If you own a stock trading at 100 and the company pays you a $2 dividend, on the exact day that dividend is issued, known as the ex-dividend date, the stock price will mathematically adjust downward to $98. You did not magically gain $2 out of thin air. The company simply moved $2 from the corporate bank account into your personal bank account. It is your own equity, just in a different pocket. Because of this, you must be terrified of the high dividend yield trap. The yield is simply the annual dividend divided by the stock price. If a solid company pays $4 a year on a $100 stock, the yield is 4%. But what if that company faces a massive scandal and the stock price crashes to $40? Suddenly, that $4 dividend represents a massive 10% yield. Beginners see the 10% and rush in, thinking they found an incredible income stream. It is a mirage. The company is bleeding cash. And it is almost mathematically guaranteed that they will cut or completely eliminate that dividend in the coming weeks. A skyrocketing dividend yield is rarely a sign of generosity. It is almost always a distress siren. A much quieter, incredibly powerful way companies return value to you is through stock buybacks. Instead of handing you cash, the company goes into the open market, buys its own shares, and essentially destroys them. They are literally shrinking the size of the pizza. If there are fewer slices in existence, the slice you are holding in your hands automatically represents a larger percentage of the total company. Your ownership stake goes up without you having to lift a finger or pay a dime in taxes. Now that you know what you are buying, you need to understand the mechanics of the actual casino. The stock exchange is simply a digital matchmaking service. When you want to buy, you are not buying from the company. You are buying from another human being or algorithm that wants to sell. The absolute highest price a buyer is willing to pay right now is called the bid. The absolute lowest price a seller is willing to accept is called the ask. The gap between them is the bid-ask spread. For massive companies like Apple, this spread is a fraction of a penny because millions of shares are trading hands every minute. That high activity is called volume. But if you try to trade obscure, tiny companies with low volume, the spread might be huge. You might buy a stock for $10, but the highest bid to sell it back is only $9.5. You are instantly down 5% the second you click buy, simply because there is no liquidity. Low volume means you are walking into a burning building that only has one very narrow exit door. When you do decide to buy, your broker will ask you what kind of order you want to place. This is a critical defensive maneuver. A market order is the equivalent of walking onto a used car lot, tossing your wallet to the salesman and screaming, "Give me a car at whatever price you want." The broker will fill your order instantly, but at whatever the current asking price happens to be. In a fast-moving market, you could end up paying significantly more than you intended. A limit order, on the other hand, is a legally binding contract. You are telling the broker, "I will buy this stock, but I will not pay a single penny over $50." If the price never hits 50, the trade never happens. You maintain absolute control over your entry point. Then there is the stop-loss order, which is perhaps the most misunderstood tool in retail investing. The industry tells you that a stop-loss is a safety net. You buy a stock at 100 and you set a stop-loss at $85. If the stock drops, the broker automatically sells it, limiting your damage. It sounds responsible, but here is the brutal reality of how markets actually move. Stocks frequently experience rapid, algorithmic flash crashes based on momentary panic or bad news. Your stock might plunge to $85 at 10 o'clock a.m., triggering your automatic sell order. You lock in a permanent $15 loss. At 10:15 a.m., the market realizes the panic was overblown, and the stock rockets back up to $110. Your safety net did not protect you. It mathematically guaranteed that your temporary paper loss became a permanent reality, and it locked you out of the subsequent recovery. This brings us to the mood swings of the market. When prices are rising and optimism is blinding, we are in a bull market. When prices fall by 20% or more and fear takes over, we are in a bear market. The speed and violence of these swings is called volatility, which is often measured by a metric called beta. If a stock has a beta of 1, it moves exactly in sync with the broader market. A beta of 2 means it is twice as volatile. If the market goes up 10, this stock goes up 20%. But if the market drops 10, this stock plummets 20%. You also have to know the neighborhoods of the market. Blue chip stocks are the massive, dominant, globally recognized fortresses. They are financially unshakable, but they usually grow slowly. Penny stocks are the dark, unregulated back alleys of the financial world. They trade for a few dollars or cents, and they are where retail investors go to have their money legally stolen through manipulation and hype. Growth stocks are companies that take every single dollar of profit and violently reinvest it back into the business to conquer the future. They rarely pay dividends, and their prices swing wildly based on expectations. Value stocks are the forgotten, unsexy companies, railroads, banks, industrial manufacturers, that are trading for less than their underlying assets are actually worth. Finally, cyclical stocks are companies whose fortunes are entirely tied to the broader economy. Think airlines and hotels. When the economy is booming, everyone travels and they print money. When a recession hits, they are the first to bleed. If you want to survive, there are certain dark arts of the market you must entirely avoid. The first is shorting. When you short a stock, you are borrowing shares from your broker, selling them immediately at the current price and hoping the price crashes. If it drops, you buy the shares back at the cheaper price, return them to the broker, and keep the difference. It sounds clever, but the math is a death trap. When you buy a stock normally, the absolute worst thing that can happen is the price goes to zero. You lose 100% of your investment. But when you short a stock, your potential losses are literally infinite. If you short a stock at $10 and it suddenly rockets to $200 because of an unexpected buyout, you owe the broker $200 for every share you borrowed. You can lose 10, 20, or 50 times your original investment in a single afternoon. Beginners should never short, period. The second dark art is margin. Margin is simply using borrowed money from your brokerage to multiply your bets. If you have $10,000, the broker might lend you another $10,000 to buy $20,000 worth of stock. If the stock goes up 10, you made $2,000 on a $10,000 account, a massive 20% return. It amplifies your brilliance, but it equally amplifies your mistakes. If the stock drops by 50, your $20,000 position is now worth $10,000. But you still owe the broker their $10,000. Your actual equity has been completely wiped out. The broker will issue a margin call, forcibly selling your assets to cover their loan, leaving you with absolute zero. Margin is the exact mechanism that causes seemingly wealthy people to lose their homes overnight. Be highly suspicious of IPO's initial public offerings. They aren't celebrations of innovation. They are exit events where founders, venture capitalists, and Wall Street cash out and pass the risk to you. Studies show IPOs consistently underperform the market in their first 5 years. You aren't getting in on the ground floor, you are buying the penthouse at peak hype. Similarly, ignore stock splits. Splitting one $1,000 share into 10 $100 shares is purely a psychological trick. It doesn't increase your value by a single penny. It just slices the exact same pizza into smaller pieces to beta-emitters. So, how do you actually build a successful portfolio? The active vs passive bloodbath. Active investing relies on experts picking winning stocks. Passive investing relies on buying the whole market. The data is clear. Nearly 90% of highly paid Ivy League mutual fund managers fail to beat the simple S&P 500 index over a 15-year period. If professionals with supercomputers can't consistently beat the market, you won't do it in your spare time on a smartphone. The solution: the index fund or ETF. Instead of trying to find the needle in the haystack, you simply buy the entire haystack. You instantly own a microscopic percentage of the 500 most powerful companies. If one goes bankrupt, the other 499 easily absorb the shock. When buying funds, you must ruthlessly audit the expense ratio. Traditional active funds charge around 1, while index funds charge 0.04%. That seemingly microscopic 0.96% gap will act as a parasite, cannibalizing hundreds of thousands of dollars over decades. Demand a fees below out 10. Never pay a premium for mediocrity. Once you buy the index, you achieve true diversification. Beginners think buying 10 tech stocks is diversified. That's just buying 10 cabins on the same sinking ship. True wealth requires asset allocation, mixing aggressive stocks with defensive bonds which act as your shock absorbers. Studies prove that your specific stock-to-bond ratio dictates over 90% of your long-term success. Next, remove emotion through dollar-cost averaging DCA. Never try to time the market, simply invest a fixed amount on the exact same day every month. When prices crash, your fixed dollar amount automatically buys more shares on sale. Once a year, you must rebalance. If your target is 80% stocks and 20% bonds, and stocks go on a massive run, your portfolio becomes too risky. Rebalancing forces you to sell some of your winning stocks to buy more of your losing bonds. Without realizing it, you mechanically execute the ultimate rule of investing: sell high and buy low. Finally, beware of capital gains taxes. The government punishes impatience. Sell a winning stock in under 365 days, and you are hit with massive short-term taxes. Hold it for just 1 day longer than a year, and you unlock drastically lower long-term rates. The tax code is literally designed to reward those who sit still. The greatest force in finance is compound interest. Like a snowball rolling downhill, it takes effort to push it first. But leave it alone for a decade and it accelerates violently. Your interest begins earning its own interest. The ultimate enemy of this process is your own interference. A famous internal study at Fidelity once found that their absolute best performing investors were literally dead. The second best group, people who had completely forgotten they had an account. Wealth building is incredibly boring, but human beings consistently destroy their own returns by seeking excitement. The roadmap is incredibly simple. Open a brokerage account. Buy a low-cost diversified index fund. Automate your monthly transfers. Ignore the financial news. Their business model relies on keeping you anxious. Every self-made wealthy person started exactly where you are, confused and intimidated by the jargon. The only difference is they pushed through the discomfort and actually started. The stock market is simply a machine that transfers wealth from the impatient to the patient. Stop procrastinating. Open the account, buy the index, and let the machine run.